Hi, everyone. Here is Dan Weisskopf, the ETF professor. And yes, it's Wednesday, not Thursday. But we'll have a happy hour anyway, right? So thank you very much, Cynthia, of course, being on the show with me. And I am the ETF professor, lead ETF strategist for the ETF think tank, and also co-portfolio manager of Block, the largest blockchain fund, in case somebody's wondering about that. And Cynthia, maybe you can introduce yourself and then, of course, introduce our famous guest.
Hi, everybody. Cynthia Murphy here, head of research for the ETF think tank. This isn't our usual happy hour day, but every day is a good day for a happy hour. So we're excited to have the show today. And we have a phenomenal guest who probably doesn't require a lot of introductions. We actually just learned before the show started that he's so famous, he's even had a bobblehead made of him. So he's welcome to share that with the audience. But Sam, go ahead and introduce yourself to the crowd.
Well, thank you, Cynthia. Thank you, Dan. I'm happy to be here. I am the chief investment strategist at CFRA Research. I was the chief strategist at Standard & Poor's for almost 28 years, but then S&P decided to get out of the equity research business and sold the equity research department to CFRA. So it's the same analyst doing the same fundamental research. We're just wearing a different uniform.
Yeah, you've been at it a long time, Sam, and making a lot of great calls. Were you expecting this start of this year to be as strong as it has been?
Well, Dan, what's interesting is that I'm a very big believer in history. You know, Mark Twain said history doesn't rhyme, but it frequently, or might not repeat, but it frequently rhymes. And so I usually start with what does history say likely to be the case. I'm going to go back a year, actually early 2023. I was fairly optimistic because I found that essentially down years are traditionally followed by strong up years. And especially when you have a positive January, you know, the old January barometer, add to that the first quarter low that did not exceed the prior December low. And those three factors, down year, up January, and a Q1 low, and you end up with about a 25% price gain with zero declines going back to World War II. So take that one step further into 2024. The question is, okay, what typically happens after a very strong year? Well, sorry, but I'll hit you with a dad joke early on. What's the difference between an all-weather radial tire and a 30% total return? Well, one's a good year, the other's a great year. And essentially, good years tend to follow great years, and that's essentially what we're starting to see so far in 2024.
But so on that, Sam, I mean, I remember seeing an interview with you, I think in December, where you actually said you thought 2024 was going to be a surprisingly good year. So history suggests that this was going to be the path. But what's driving that path? Is anything in there surprising you? I mean, we keep seeing the same drivers dominate. Is that as expected, or are the drivers surprising you at this point?
Well, in a sense, the drivers are doing what they traditionally do. Frequently, people will ask me in the beginning of any new year, should I buy last year's winners or last year's losers? And I say the right answer to most financial questions is that depends. So following a down year, you actually want to buy into the worst performers from that down year because they tend to bounce back significantly in the subsequent year. So the worst performers in 2022 were communication services, consumer discretionary, technology. And what happens is investors rotate from first to worst, meaning they get out of the defensive groups that held up best in the market decline and into those that were beaten up the most. Following an up year, you're actually better off letting your winners ride because the top three sectors on average tend to go on and post positive returns 82% of the time versus the market's 73% advanced frequency. And this strategy has beaten the market 7 out of 10 years going back to 1990.
Well, what about macros, though? Sam. I mean, I follow your train of thought. It seems like to me, inflation is on everybody's consciousness these days, right? And maybe it's under control, but it's so hard to beat inflation, right? And to manage it. What are your thoughts around inflation?
Well, heading into this year, our expectation was that certainly the Fed was already on pause. And again, I go back to history and say what typically happens is that the Fed tends to pause for about 11 months between the last rate hike and the first rate cut. So we've been saying for quite some time that we believe that June will be the first cutting period for the Fed, and we'll probably end up having 3 cuts this year, not the 4, 5, 6 that the market had been anticipating. So our belief is that the Fed will be slower to lower interest rates. They'll do so later in the first half of the year, and will do so just 3 times this year, but then continue into 2025. I guess I'm not surprised that inflation can remain fairly sticky, because really what you're doing is making month-to-month and year-over-year comparisons. It's not we're not seeing deflation. We're just seeing a slowing of the rate of pace to the upside. So the CPI numbers that we got earlier in February took a lot of people by surprise. The PPI numbers sort of confirmed the stickiness of inflation, and then the PCE numbers people are waiting for to see what that will be. And I equate that to the dropping of a ping pong ball on a table. The first response is the greatest, with subsequent responses being a bit more muted. So I don't see the market responding to the PCE the way it did to the CPI and then the PPI.
Do you want to go, or you want me to go?
No, I was just going to make a comment, and not to go into politics, but being an election year, I think it's interesting, this inflation conversation, because I love the distinction between a slower pace of acceleration inflation versus deflation. And when you look at all these political ads, it's all about, look, inflation has come down. No, it hasn't come down. It has slowed down into going up. But it's so easy to get everybody confused about this and making wrong assumptions about the market and the economy and all those things. So I love that you make that distinction so clearly.
Well, go ahead, Dan.
No, and that definitely leads to a smoother ride, right? For equity markets, and so it's logical that we'd be strong in January. The question for me is, what does it mean about whether or not the market's going to broaden out? I mean, that's always something that you talk about. And what does it mean for small caps if you think it's going to broaden out?
Right. Well, I think the question is, are we topping out or broadening out right now? And I think that we are broadening out, primarily because, yes, investors had to reset their dials by saying the first cut won't be in March. It'll then be in May, most likely June, and that we will have fewer of these cuts. But in some ways, that's actually a good thing. If the Fed needed to respond very quickly and very dramatically, the implication was that they were worried that a recession was right around the corner and that they needed to combat the effects of that recession. So I think that because the risk of recession continues to abate, then I think we are first off seeing an increase in the number of industries and companies participate in this advance. There are 153 sub-industries in the S&P 1500. And if you look at them on a 10-week or 50-day moving average, 40-week or 200-day moving average, or looking at both of those, what we find is that we're currently at above average readings going back to 1995. So a majority of these sub-industries are trading above both their 10-week and 40-week moving averages. That's a positive. Also, recently, we've been seeing small cap stocks start to improve and do fairly well. And quite frankly, I think they are very attractively valued. Right now, the S&P Small Cap 600 Index is trading at a 35% discount to its average relative PE over the last 20 years. and the mid-cap 400 is trading at a 30% discount. So should we end up with the market continuing to advance as we get closer to the first rate cut and sidestepping a potential recession, I think that would continue to be good for a broadening of participation.
So what could make that not the case, Sam? Like I asked us, like a couple of weeks we were at an ETF conference, and a lot of the macro panels, it's almost like the thing we love to say at the beginning of every year, like we should all be eating our vegetables and then we just go out and order pizza. So we should all be like buying the better valuation, small caps, international stocks, and then we just go out and pick up more NVIDIA stocks. So
right.
Should we continue in this obsession about these winners and just piling up in there and actually prevent this broadening out from truly materializing? Or there's no way, this is where the market is going and we're going to see this broadening everybody's looking for?
Well, you're bringing up a question about what should we do and what do we really end up doing? Because I think people need to be convinced that they should be doing something. And in the sense of investing, I like to say that fundamentals tell you what, but technicals tell you when and how far. And so when it comes to small caps, yes, they are attractively valued, but I think investors are waiting for a signal where the small caps are moving back above their own 10-week and 40-week moving averages, doing better on a relative strength basis versus the S&P 500. And then the only one emotion that drives stock prices, in my opinion, which is fear of losing money on the way down or fear of missing out on the way back up, then I think we will start to see an improvement in the momentum behind gravitating toward the mid and small cap stocks as investors start to worry that, maybe I'm missing out on this upward move.
So along those lines, you have preferences across different asset classes or sectors? However you want to answer. Those are maybe two questions in one. Sorry.
That's okay. I would say from a sector perspective right now, we have overweight recommendations on communication and services, consumer discretionary, financials, and technology. We obviously monitor them on an ongoing basis to see what needs to be changed, either based on fundamentals, based on technicals, et cetera. We do favor the smaller cap stocks for the long term. During the pause period, going back to 1989, which is when the Fed started to be transparent with Fed funds moves, the S&P did the best, up 14% in that 11-month period as investors anticipated the first rate cut. But small caps did relatively well, up 9.5%, and both of them were higher in 5 of 6 periods of pause periods between the last hike and the first rate cut. So, I would tend to say, in terms of small caps, our feeling is you go more toward the broader ETFs. But in terms of the individual larger cap stocks, yes, we have sector recommendations. And then our team of equity analysts then have stars recommendations on more than 1,000 stocks.
Yeah, we dive a little bit into that, Sam, the financials versus tech as two of the winning segments. It's an interesting call. So can you walk us through the case of tech, for example, which in the S&P 500 was up more than 50% in the last 12 months, while financials did well, but nowhere near that kind of performance. It's, more closer to the bottom half. So walk us through your thinking on both of those sectors.
Sure. Well, both of them are going to be beneficiaries from a lower interest rate environment. Technology, a lot of people gravitate toward as mainly because that's where the proven growth happens to be. So earnings growth expectations remain relatively strong. What concerns me a bit right now, though, is we have advanced more than 23% on the S&P 500 since the correction low on October 27th. We have not had any kind of a meaningful digestion of recent gains. Also, we recovered everything we lost in the prior bear market on January 19th. And history basically tells us, well, we advance another 5% before stumbling from exhaustion and give back anywhere from 5 to 10 to as much as 15%, with the average being about 8%. So I'm thinking that I wouldn't be surprised if we did end up seeing a pullback in prices, probably those groups that did the best getting hit on the chin the most because they had the most profits to lock in. But I still think that if we are on the trajectory of lower interest rates, also seeing good earnings growth, well, we probably need to see an improvement in earnings growth because right now technology is bumping up against resistance at about a 30 multiple for the S&P 500 tech sector. So if we can see an improvement in earnings expectations, then yes, we can see the tech sector continue to do well, but it probably won't be as a result of PE multiple expansion. Talking about the financials, here is a group that we think will benefit from a lower interest rate environment, but there is, in a sense, a tale of two cities. It's the larger banks that we think are better positioned right now. Certainly the regional banks have greater upside potential if the worry is removed, the overhang is removed from these regional bank groups. They tend to do fairly well in an early rate reduction cycle, but I think people are still worried about what happened almost a year ago and wondering whether something like that will happen again. So I think they, like small cap investors, are waiting for the Fed to actually start to cut interest rates before piling back in.
Now, when you're speaking about financials, you're highlighting banks, but financials are a broader category. And I think I think I heard you mention a stock, American Express, that you also favored. Can you talk to us a little bit about why American Express, and then also how technology is actually affecting financial services?
Sure. Well, they are becoming so much more intertwined, where a lot of the transaction processing companies, you wonder sort of, do we put them into technology? Do we put them into financials? So American Express in the transaction processing areas, consumer finance, when we continue to see the unemployment rate remain below 4%, our expectation is that it's going to be around 3.8% by the final quarter of this year, and maybe peak its head above 4% for all of 2025. So we're still expecting the employment picture to remain fairly firm. Yes, we are beginning to see an increase in debt levels for consumers, but we don't think that we're getting to a period just yet in which we really have to worry about them not being able to pay off that debt. So a company like American Express, Visa, we think are well positioned to benefit from low unemployment rates and continued spending. You also mentioned about financials. Well, insurance is also a fairly large portion of the financials category. This is a group that had been doing relatively well because they've had the ability to improve their pricing structure, and that's something that is continuing to assist earnings growth. So banks, the insurance companies, the transaction processing / consumer finance companies, we think are well positioned for the year ahead.
Then do you think along, when we talk about sector themes, do you think along the lines of an overarching theme, like we talked a lot about AI, for example, NVIDIA being a key player in that space, how these kind of non-sectors, cross-sectors, let's say, themes are impacting different sector outlooks? Or is it the case that, for example, a story like AI is just beneficiary to pretty much everybody because nobody's going to escape the AI technology? They can, improve all sorts of industries.
Sure. Well, AI really was the poster child for growth back in 2023 and is maintaining that mantra so far this year. In 2023, semiconductors were the best performing sub-industry, well above the 100% growth level. And so far in 2024, it is also doing well, up almost 64%, so almost 3 times what the S&P 500 has done on its own. So, the feeling is that we are in the embryonic phase of this AI cycle. Our belief, Angelo Zeno is our semiconductor and AI expert, if you will. And the belief is that we're in the beginning phases of this. And right now, a lot of attention, forecasting and whatnot are geared toward things we really don't know how AI is actually going to be benefiting us to the extent that we think it will. Certainly, we play with it a little bit in terms of GPS, in terms of spell check, in terms of other recommendations by AI. Chat GPT students now turning in term papers that sound pretty much the same. But in terms of how we can have artificial intelligence improve our lives going forward, whether it's with self-driving automobiles, et cetera, there are just a lot of uses out there, and therefore the world tends to be the AI oyster.
Yeah, I mean, I think technology is going to play a huge role in the financial services industry on a go-forward basis. I know that Visa and MasterCard, American Express to a lesser degree, but other big banks are also involved in blockchain. Mm-hmm. I know we're talking about AI, but do you have any views on blockchain?
Well, we cover one stock, and that's Coinbase, and we do have a hold recommendation on that. I guess blockchain, certainly that is the future, but in terms of Bitcoin and making a recommendation there, what I find sort of interesting is that, how can you really get overly excited about something that has no earnings, that pays no dividend, has no commercial value, if you will, not even used in jewelry. I mean, since it is a virtual currency, it would be virtual jewelry, and so you'd be wearing the emperor's clothes if you donned a Bitcoin. So right now, I think it really is geared toward those speculators who are really trying to get it one step ahead of the next person.
I'm going to respectfully disagree, but not on this show, Dick. You want, but I definitely hear you out, and you're factually correct. It's a challenge in trying to figure out how to value Bitcoin specifically, but the use case is really, I think, where people agree in the context of the evolution of the technology. But we'll come back to that at another time. Clearly, as you were pointing out, as an asset class, there's a little bit of FOMO happening right now, and that's just the way things work, I'm sure.
Yeah. Well, don't get me wrong. I'm not saying that I expect Bitcoin or blockchain to vanish years from now, but rather, no, we are in the early stages of this as well. And it does appear as if virtual currency is what the world is heading toward. I guess my question is, I'm not smart enough to know how to value it at this point. That since it is really just based on price, I think only CMTs really know, technicians know how to accurately value the movement in Bitcoin right now.
Fair enough. Cynthia, you got a question, or you want me to keep going?
No, you can keep going. I'll just say, it's not easy to be a Bitcoin skeptic, Sam. Not in today's market. There's not a lot of room to have any doubts. But I think that the actual pricing question is totally fair. And I think we'll get there. I mean, I think right now it's all anchored on the supply-demand fundamental, just basic, supply is limited and demand is growing. Therefore, this chart can only move in one direction. But I think it's a healthy conversation to keep having.
Sure.
We're not big believers in FOMO around here. We're believers in sensible due diligence, right? Right, Dan?
Of course. But Sam, I'll switch it up a little bit for you. We have a question about energy, right? Where do you stand on that sector? Because there's a lot of use case for energy companies who make a lot of money.
Well, we have a market weight recommendation on energy right now, and we sort of wondered, maybe we should have had it as an underweight recommendation. But we're sticking to our guns right now because our belief is that we are not headed into a global recession. We do believe that oil prices will be working their way higher, even approaching the $100 per barrel level in 2025. Really, it is a question of supply, demand at this point, and we still do favor some of those categories. But, right now the momentum is just working against the energy category.
Which is great for the economy, right? So
sure.
I want that.
There's an old saying that for every $10 decrease in the price of oil, it adds 20 basis points to real GDP. So, yeah, the lower oil prices go, the more that, in a sense, we can use and therefore not have to use our budgets to pay for it. So, yes, lower oil prices do tend to help economic growth.
Which brings up a question that I wonder about. And maybe it's not fair to ask of you, but you probably would have insights, and you're the king of statistics. Energy is about a 3% weighting in the S&P 500. It's kind of borders on being irrelevant, right? Why is it so low? Why is that acceptable when it's such an important commodity?
Well, the interesting thing is you go back to 1970, and it was the tech of the S&P 500 with a weighting of about 28%. And it's not just energy that's now at this sub 5% level. You've got materials, you have real estate, you have utilities that are at such a low level. And you do sort of wonder, are we going to continue to have them? Do we put energy and materials together because they have, relatively high correlations with one another? But since, it's more a matter of correlation and price movement, they do still march to a slightly different drummer. But right now, it is communication services, consumer discretionary, healthcare, and technology that are the behemoths. You could have probably also add financials and industrials because they're all in the low to mid-teens weighting, but tech is by far the largest.
Yeah, but I love that question, Dan, because if you actually, when you think about that, it's a head scratcher. I mean, as a human being, you can't live without the real assets, the resources. But we theoretically could live without our phones, right? So it's kind of interesting that all our eggs are increasingly in the basket of discretionary varieties as opposed to real assets. But does that speak more to the stocks versus the economy itself, or does that speak to both? Like, is the growth opportunity only in these stocks, but the economic reality is different? Or what does that say about the state of the economy, I guess?
Well, my first thought would be, I think if you did a poll, you'd find a lot of people feel their phones are more important than some basic materials.
Yeah, just with my kids, yes.
Exactly. Well, it's just one of those situations where, yes, these are different areas of the overall economy, but the focus really is on where the growth is, because as we move closer and closer to electric vehicles, alternative power sources, whether it's solar, hydro, et cetera, the focus is to be carbon neutral by 2050. A lot of companies are trying to say. So if the intent is to push down the use of fossil fuels, well, then you could see how people might be less inclined to want to be chasing those areas. I think it's going to take some time for that to occur. What is it? It's like 75% of all powered items are still powered through fossil fuels. So it's going to take a long time before we end up turning off the spigot to energy. And certainly basic materials, a lot of the basic materials go into the new industrial manufacturing in terms of electric vehicles, et cetera. So it is important, but in terms of what the investors want to be buying, I know that S&P does try to have the S&P 500 be reflective of the economy, but more so of the overall stock market itself.
Yeah, but my point is, 3% as a weighting. I mean, you highlighted that you were underweight. You might as well be zero, right? Literally, and it's such an important industry to our current economy. What it ends up being 5-10 years from now is, well, anybody's guess. I wish I understood, and I'm going to now try and figure this out because I'm curious why it is literally so low, and it has been for years. You would think that the process would have at some point brought it consciously and with action up to 5%, just so that it reflected the economy.
Well, I guess that's a question you probably should be asking those over at Standard & Poor's in the index department, because when you think of it, 3.7% is the weighting of the S&P 500 energy group. You're looking at materials, real estate, utilities that are less than 2.5%. So do you get rid of those industries as well? If that's the case, you might as well try to turn the S&P 500 into another NASDAQ 100, but that's already out there. So, try to offer as rounded a pie as possible. But you're talking to the wrong one, because I have no control. I am a follower of the index. I am not a manager of it.
So is real estate for you I guess you've already answered this question, but so often people talk about real estate as an alternative asset class. I don't see it that way. To me, it's an equity, therefore it's an industry. Why do some people see it as an alternative asset class? Because it's a business.
It's a business, but it tends to have longer cycles, longer contract cycles than other businesses. And also because it does end up sort of acting as an alternative investment, what you find is that a lot of studies have shown that if you have 5, 10, 20% exposure to real estate within the overall portfolio, you can end up with returns that are similar to the S&P 500, but with lower volatility. I would actually argue for a 2-sector portfolio that offers an awful lot of diversification and relatively low volatility, and that would be technology and consumer staples. We know that consumer staples is the poster child for stability, technology, the poster child for growth. But the interesting thing is that while tech is the best performing sector since 1990 at a 12.5% compound annual growth rate, its standard deviation is about 31 versus the market's standard deviation of about 17.5. Yet a 50% portfolio of tech and a 50% portfolio of staples rebalanced annually actually delivered 96% of the return of tech alone, with 40% less volatility since 1990. And at the end of 22, this portfolio did better than tech itself. So interesting that when you take two asset classes, two sectors that take the stairs at different rates of pace, you end up having a truly diversified portfolio. And in my book, The 7 Rules of Wall Street, that nobody bought, one of those chapters is who says there's no free lunch on Wall Street, and that is this tech and staples portfolio.
So that's, when did you write your book again, Sam?
The book came out in February of 2009, and in my preface, I quoted the greatest of all financial philosophers, Charlie Brown, who once said, "I have a feeling that when my ship comes in, I'll be at the airport." So I said, don't be at the airport or in cash when the market finally turns around. And it ended up being sage advice.
And guys, you heard it here first. But so this relationship, tech and staples, has been sustained since then?
It has. As I just mentioned, through the end of 2022, the portfolio actually exceeded the compound annual growth rate for tech alone. And it did fairly well in 2023 as well, obviously because tech carried consumer staples. But it's one of those situations where, you can get something for nothing, hence the free lunch analogy, because you're getting almost tech's return, but with 40% less volatility.
So what other, in that same vein, like what are some of the other opportunities that you think are, maybe overlooked right now? Where do you see spots that we either haven't cared as much as we should, or we haven't taken a closer look?
Well, we were talking before the actual program launched about an ETF that Pacer has brought out based on another chapter in the book that has to do with sell in May and go away. I like to say rotate, don't retreat, meaning stick with stocks, but like whitewater rafting, let the market take you where it traditionally wants to go. So May through October does tend to be a fairly challenging period in the market. The average 6-month return is only about 1.6% since World War II, but it's 6.6% on average from November through April. So typically what you find is that investors gravitate more toward the defensive sectors May through October and stick with the more cyclical sectors November through April. So this ETF SZNE, the seasonal rotation, does just that, invests in healthcare and consumer staples from May through October, but then in consumer discretionary, industrials, materials, and tech from November through April. So it allows an investor, in a sense, to be at the amusement park the whole time, but they're on the roller coaster 6 months of the year and the merry-go-round the other 6 months.
So sorry, I was having some technical problems, so I had to come back. I heard all that. That was great. And are we allowed to mention the ticker, Jim?
You're allowed to, sure. SZNE for the seasonal rotation. As I mentioned to you before, the wholesalers used to call it sneezy before COVID. Now they just call it the seasonal rotation ETF.
We'd like that, Sam.
And yes, I do own it, and CFRA benefits if people buy it. So that's my disclosure.
And by the way, well, as long as they're doing the advertisements, if you're interested in launching a second ETF, I hope you'll call Title, because we can help you with that.
Next time I do that, I will.
Okay. I'm always a little bit baffled around Amazon, which I know you're a believer in. Technically speaking, it's a consumer discretionary, right?
Right.
But I always kind of look at it as a technology company.
Well, I agree. But it is the how you get to the consumer discretionary items is through a technology portal. But what you're doing is you are buying items instead of going to Macy's or Target or Home Depot or whatever. You're just going to Amazon because people don't eat the vegetables, don't go for a walk, and don't get out of the house. So they say, well, let me just go online. But at the same time, it actually helps in terms of pricing because you can do an awful lot of comparative shopping when you do so online, not going into a store blind, not knowing what, unless you have a subscription to Consumer Reports, knowing what is the right item to be buying. So again, this is a company that has been included in consumer discretionary. What is interesting is that Walmart, Target, Costco are in consumer staples because a majority of their items sold are food related. So again, it comes down to a very fine line between, is this a discretionary item? Is it a staple item? Is it technology? Is it financials, et cetera? So sooner or later, I think as time proceeds, that those lines will get increasingly blurred.
When you first came across Amazon, when it was just a bookseller, right? What were your thoughts about that company, that idea?
Yeah, well, I guess I was a bit old school, probably still am. And so when they first came out, I said, well, that sounds interesting, but I probably wouldn't mind going to Barnes & Noble, to Borders, Walden Books, to actually just look at the book itself, to get a feel for it. You know, being a child of the 60s, I'm used to holding a newspaper or a magazine, etc., and it took some changes to actually read the Wall Street Journal on my iPad. I need more powerful glasses to be able to read it on my iPhone, so I'll just stick with the iPad. But yeah, what seemed like a okay idea ended up being a tremendous idea.
I hope you keep your open mind for blockchain too in the same way, my friend.
Oh, I'm not discounting blockchain. I think it's definitely the future. I can't rationalize where the value is going to be exactly.
I think
and we're all bullish the eyeglass industry. I can confirm that.
Okay, I'll put my glasses on.
Yeah. I just need to get the kind that come out like this or whatever. So,
what about healthcare? We haven't talked about healthcare of all things. Actually, if you think about it, that's a pretty staple industry.
It is. Some people feel that healthcare, like staples, is a good antidote, if you will, to technology. But there's an awful lot of technology in healthcare. But we do like healthcare, or at least are warming up to it. We have it as a market weight at this point. We did have it as an underweight recently, and it's among the sectors. So healthcare, industrials, tech are the three that have been hitting new all-time highs. I think healthcare hit 6 new all-time highs this year. We had industrials do about 14 of them, tech at 13. The market itself at 13 or 14. So these are sectors that are actually improving. Healthcare did have some pushback because of the Inflation Reduction Act. And so the concern is about Medicare, the pricing of drugs. That's going to go into effect in 2025. And so I think there was concern that there would be pushback, but there certainly, as we baby boomers continue to age, it's those items from the healthcare system that are going to be used more and more. So earnings are expected to be up about 15% in 2024 versus the 9.1% that is currently projected by S&P Capital IQ consensus estimates. So versus the 0.3% earnings growth last year, the feeling is that things will be improving this year.
So, Sam, we've got a couple of questions from the audience. Ray Scheimer, my friend, asked the question, and he's also a portfolio manager, I should say. Thoughts on the U.S. deficit debt situation on financial markets, shorter term, long term. So, Sam, you get the question? What are your thoughts on those?
Well, I think that that was the reason why or at least one of the reasons why we had the backup in the 10-year yield approaching the 4.5% level, approaching the 5% level. And certainly we had reminders that the average 10-year yield going back to 1954 was about 5.5%. So it really is sort of like the old normal coming back. I think that the longer we maintain this kind of a debt level, deficit spending, et cetera, the more challenging it's going to be for the financial markets, for the government itself, that it'll be sort of like, the money boxes that are chained in the Christmas Carol, where it's going to be harder and harder to drag them along. And so my feeling is that this is something that we do need to address. Yes, the U.S. can pay off its debt by simply printing more money, but what is that going to do to the confidence of the U.S.? And that's going to end up pushing down the value of the U.S. dollar, probably make your international investments all the more attractive, which are trading at about a 20% discount to their long-term average relative PE. But I do think that longer term, that is an issue that will come back to haunt us.
So I'm gonna call you king of stats because you're great at this. And I feel like I pulled the question away from you, and I apologize, Cynthia, when she was leading up to the elections, right? Historically, how have markets done in the election year and thereafter?
Historically, when you're looking at an election year for a first-term president, The market posted an average total return of about 15.5%, rising 100% of the time. And that's whether the incumbent gets reelected or replaced. Looking at all election years since World War II, if we started out with a positive January, the market was also up by about 15.5%, a little higher than that, and again with a 100% batting average. So I think investors, again, history says that you're going to be surprised by how well the market performs. The market can also give you a good idea as to who will get elected, because take a look at the price performance of the S&P from July 31 through October 31. If the market goes down, then the president tends to get replaced. And it's been correct every time except once. 1956, Adlai Stevenson was not likely to be defeating Dwight Eisenhower, but we had two very big geopolitical events take place in October that shook global markets. We had Gamal Nasser, who seized control of the Suez Canal and prompted a military response by Britain and France. Then we also had the Hungarian uprising that was crushed by the Soviet tanks rolling into Budapest. So that caused a double-digit decline in October of 1956. But every other time, a down 3-month period just prior to the election signaled the replacement of the sitting president. So we got correct calls certainly in 2016 and in 2020.
Well, you lived up to your reputation with all those stats.
Good. Good for something.
Yeah, no, I love it all. Sam, thanks very much. This has been great. I hope you'll come back. Cynthia, do you have any more questions?
I was just going to make the comment. Now I'm going to be counting down to the 3 months prior to the election for looking for the clues. So I thank Sam for that. But I thought as we wrap here, Sam, will be just like a cool opportunity for you to tell us, a little bit about CFRA. How do you guys go about your business? How can people access all your insights and the research? And for people who don't know the firm, this is an opportunity to tell.
Oh, absolutely. Well, thank you for that opportunity. Basically, go to CFRAresearch.com, and that's the best place to learn about CFRA. The company started in the mid-1990s. A gentleman named Howard Shillett created the firm focusing on forensic accounting and was able to uncover Enron, WorldCom, as I understand. Peter DeBoer, who is the president of CFRA, he wanted to round out the independent research offering and therefore purchased the S&P Equity Research Group back in 2016. Since then, we have added Lowry Research, which is a technical analysis firm, and Washington Research, Washington Analysis, which is a Washington a service that basically goes in and listens to all of the proposals, the House bills that are going through to see if the likelihood is that they will be passed, what kind of an impact would it have on particular sectors, et cetera. So we do offer free trials to our Market Scope Advisor platform as well as our Lowry platform. So thank you for asking, but go to CFRAresearch.com. And that'll give you a deeper understanding of what we can do.
Last chance, plug your book and tell us you're going to write a second one.
Well, actually, this is my third book. I wrote two back in the 1990s, looking at the sector rotation through average economic cycles since World War II, referenced by Fidelity in their select sector publications. But the one that I think is most practical, which you can buy on eBay, it's out of print. I wouldn't pay more than $10 a copy, though, has 7 different portfolios that one can embrace. I like to say that the best bit of investment advice I ever got came from Clint Eastwood. When he was playing Dirty Harry in the movie Magnum Force, he kept mumbling through grit teeth, "A man's got to know his limitations." So if you are one whose emotions can be your portfolio's worst enemy, then my recommendation would be A, acknowledge that, and B, embrace a rules-based investment approach and therefore you can benefit from stocks. Just extract your emotions from the equation.
I guess you want to do one more dad joke, or that'd be pushing it.
No pressure here. So I already told you about the good year or the bad year. So we'll save a new dad joke for the next time I'm on. How about that?
Sam, you're great, man. I hope to see you soon. Thanks for the time. Cynthia, always a pleasure.
Yeah.
Everybody who's listening, wonderful. Go ahead, Cynthia.
Thanks for inviting me, and I'm glad I had a good time with you guys. Look forward to it again. And Cynthia, you were going to say something?
I was just going to say thanks. Thank you, Sam. Thanks, Dan. Thanks, everybody, for joining us. Always a pleasure. And we will see you all next time.
Look forward to it.
Ciao.